Today, nothing ever happens as markets reach all-time highs again. Hello again, it's Martin North from Digital Finance Analytics, well, that is post covering finance and property news. This is our weekly market update where we start in the US, cross to Europe and Asia, and end in Australia, covering commodities and crypto along the way. Well, it's been another extraordinary week as the MSCI Global Index hit a new all-time high, along with the S&P 500 and NASDAQ. Investors hope the US is moving swiftly to securing trade deals with its key partners and that Republicans are set to approve President Donald Trump's key tax bill soon, as well as betting that the US interest rates will also fall. The STOXX 600 in Europe, though, is off its all-time highs, and the ASX 200 also fell on Friday. Nevertheless, this is a stunning turnaround from the post-Liberation Day tariff gloom of early April. Or does it support a new market theory that's achieved meme status? Nothing ever happens. The idea is simple. Every time a supposedly market-shifting, world-shaking event arrives, its impact quickly fizzles out. The Russia-Ukraine war, it's a temporary blip. The collapse of Silicon Valley Bank and Credit Suisse, merely a week of turmoil. Bond market chaos, the carry trade blow-up, the British gilts crisis. Who cares? It's merely a flesh wound. This theory got more attention this last week when The Economist columnist Mike Bird brought it into the mainstream with a piece titled "Investors Ignore World-Changing News Rightly." Bird's piece in The Economist referenced a study that showed, contrary to what we might expect, market volatility was actually much lower on days when apparently market-shaking news occurred. Perhaps Bird quite reasonably argues this is explained by the fact that such events are extremely hard to price and or hedge against. All of this feels a bit silly, given Wall Street fell almost 20% between late February and early April after US President Donald Trump announced tariffs on America's trading partners. Clearly, something happened then, but the speed of the recovery has been stunning, and with the end of the financial year approaching, the drama of this year won't really show up in the returns of equity investors. The ASX 200 will deliver about 10%, while the S&P 500 will do about 11.5%, so who wouldn't take that? But there is another explanation. Then it might be that there's a dramatic change in the structure of markets as the rise of passive investing and algorithmic trading, the build-up of retail investing, and the shift from public to private markets means markets function very differently from a decade ago. Throw in the fact that investors have been conditioned to buy the dip, that's a strategy that's worked brilliantly for the last 3 years, and you get a market that either quickly bounces after any setback or doesn't meaningfully sell off at all. Now, my concern is that markets seem to be completely disregarding tail risks. I discussed this with Harry Dent in my post this week, as the bubble surrounding financial markets becomes so big that it's simply not in the interest of governments or central banks that deflate, and so they respond to every little crisis with fiscal and monetary stimulus. But the bigger the bubble gets, the worse inequality becomes, and the more vulnerable the world becomes to periods of inflationary pressure. That said, the problem with the nothing ever happens mantra is that it could be dismissive or underpricing real risks entirely. None of this matters until, well, it does. And with markets historically expensive, the price of complacency may well be high. While the world has gone more complacent and the risks of a wider conflict grow, we still seem to be in a situation where the status quo is under great strain, but still holding on, at least for now. But the potential for a government debt crisis to blow up, bond markets will get bigger as polarized societies demand that governments spend away their problems. Policy decisions taken in this environment will also keep playing out. Just one example is Trump's immigration crackdown, which would eventually choke off labor supply and push up wages. Inflation, interest rates, and the rise of AI is another, and the fallout from the trade wars a third. Actually, President Donald Trump touted progress on trade deals with a few countries, naming agreements with China and the UK, while saying that he was ending discussion with Canada because it is set to impose a digital services tax on Monday. That news dented Wall Street's upward momentum, actually, and Treasury Secretary Scott Bessent earlier in the day said the Trump administration's agenda for trade agreements could get wrapped up by the Labor Day holiday. China said that it was further confirming details of a trade framework with Washington, and the EU and the US believe they could clinch some form of trade agreement before the July 9th deadline. The shift in sentiment was sparked by US data that pointed to a slowdown in the world's largest economy. Consumer spending grew in the first 3 months of the year at the softest pace since the onset of the COVID-19 pandemic, causing domestic product growth to slide at a downwardly revised 0.5%. That unleashed a rally in treasuries as traders ramped up expectations of rate cuts by the Federal Reserve. Bond markets had already fully priced in 2 further rate reductions this year, and they've ramped up those bets now for a third. The 10-year yield was last at 4.280, while the 30-year Treasury was at 4.834. The moves were supported by reports that US President Donald Trump is considering naming a Fed Chair Jerome Powell's successor as soon as September, October. That's well before his term ends in May 2026. Trump has become frustrated that Powell has not delivered a lower Fed funds rate, triggering expectations of a more dovish replacement. After the markets closed, Trump told reporters that he would love if Federal Reserve Chairman Jerome Powell would resign, and that he is keen to replace him with someone who supports cutting rates. Talk about objective independence of the Fed, huh? Actually, Fed Chair Jerome Powell pushed back against suggestions that rate could be cut as soon as July, arguing that the impact of tariffs should be assessed first, and the consensus among the Fed's 19 rate setters is to hold the line too. But traders are still leaning towards 3 quarter-point cuts this year. Mirroring the increase in the Consumer Price Index in May, personal consumption expenditures, the PCE inflation, rose last month. That's according to the US Bureau of Economic Analysis. The PCE, which is the Federal Reserve's preferred gauge of inflation, jumped to 2.3% in May, up from 2.1% in April. The 2.3% inflation rate was in line with economists' estimates. For the month, the PCE rose 0.1%, also in line with estimates. It ended 3 months straight of 12-month inflation rate drops. The increase in the PCE coincides with rising tariffs, of course, as May is the first full month that the new tariff comes into effect. And core PCE, which excludes food and energy costs, jumped to 2.7% in May, up from 2.5% in April. That was higher than the economist's consensus view of 2.6% for core PCE. For the month, core PCE climbed 0.2%, which is also higher than the 0.1% projection. Now, standing back slightly, there is still a risk of a speculative stock bubble. It's increasing as bets on rate cuts draw massive investment flows into the US, according to Bank of America's Michael Harnett. Already this year, 164 billion US dollars have flowed in to US equities this year, which is being on course for the third largest annual inflow in history, he said. Anyway, the S&P 500 rose 0.59% to 6,178, surpassing the previous peak of 6,147 on February the 19th, while the tech-heavy NASDAQ gained 0.59%, exceeding its record high of 20,204 on December the 16th. The Dow closed at 43,819, though, well below its 45,000 peak last year. Below the hood, markets benefited from a US brokered ceasefire of the 12-day air battle between Iran and Israel that sparked a jump in crude prices and raised worries of higher inflation. And it also rallied as an upbeat forecast from chipmaker Micron revived investor confidence on AI, and Nvidia inched closer to the $4 trillion market capitalization after reclaiming its position as the world's most valuable company. The AI bellwether rose 1.4%. Advanced micro devices were up 1.6%, while megacaps Meta added 0.7% and Amazon was up 1.15%. But be warned, market breadth is very narrow as AI-related stocks boom on. Despite the S&P 500 sitting near record highs, participation remains narrow. Only 22 stocks are currently at all-time highs compared to 67 back in January. This signals risk. And the S&P 500 rebound is the strongest, most quick in history, which is also not comforting. It is all too quick. Over in commodity markets, oil had its biggest weekly decline in 2 years, following the ceasefire between Israel and Iran. Brent tumbled over the past 5 days to around 66.34 US dollars a barrel, and the WTI was last at $65.07. Easing geopolitical tensions caused gold to fall, with the futures contract down to 3,301. But the precious metal is still up more than a quarter this year and sits around 200 US dollars below its all-time record reached back in April. The most significant market move of the week was, however, not in equities, but in currencies. The dollar, the US dollar, continued to decline and is now down more than 10% this year. That's its worst first half performance of any year in more than 50 years. Now, it should be remembered that the dollar started the year at extremely expensive levels, so any adjustment is always expected and down. This is proving to be a pretty severe adjustment, though, and one which markets and policymakers appear to be relaxed about. For now, the dollar index was down just a little to 97.25 on the day, holding near its lowest level in more than 3 years. The dollar is having its worst start to a year since the era of free floating currencies began in the early 1970s. Oh, and incidentally, the US got an exemption from the OECD's Pillar 2 corporate tax reform, and the onerous revenge tax of Section 899 of the budget proposal will also be dropped. And there's also talk that the postponement of the so-called reciprocal tariff may be extended for the current deadline of July 9th. While the greenback has steadied, it has found little traction and remains largely pinned near yesterday's lows. Canada's main stock exchange shed its gains to close lower as Donald Trump cancelled trade talks with Canada. The average notched a fresh all-time peak in the prior session, so the S&P TSX Composite settled 0.22% lower at 26,692, pairing gains from the record high logged just previously. The news comes after Statistics Canada released data showing a 0.1% contraction in Canada's real GDP in April, which is lower than analyst estimates, and a decline from the 0.2% March gain. European stocks rose on Friday, ending the week on an optimistic note after weathering a few weeks of heightened Middle East tensions and uncertainties over tariffs. The DAX index in Germany closed 1.8% higher. The CAC 40 in France also climbed 1.8%, while the FTSE 100 in the UK rose 0.7%. French consumer prices rose slightly, more than expected, posting an annual rise of 0.9%. That's above the 0.7% prediction, while Spanish inflation also gained 2.2% on the year, above the 2% expected. German long-dated government bond yields had their biggest weekly increase in nearly 4 months after rising this week on expectations of increased borrowing by Germany's government. The yields on the benchmark 10-year Bund fell 1 basis point to 2.588%, but notched a 3.3% weekly increase. That's the highest since early March. The UK government, with 3 U-turns under its belt in so many weeks, just 1 year into office, raised questions about tax hikes incoming in the autumn budget. And meantime, the pound is paying attention to industry reports, which points to a slowdown in the UK labour market. A report issued by the British Chamber of Commerce stated that around 1/3 of small and medium-sized UK employers have made staff redundant or are considering job cuts as a result of the increased tax burden. The pound was at 1.3721 against the US dollar. Asian stocks advanced on Friday, with Japan leading gains as a rally in US tech shares lifted sentiment, while investors weighed Tokyo's cooling inflation, which clouded the outlook for further Bank of Japan rate hikes. Gains were limited and investors remained cautious ahead of the July 9th US tariff deadline, despite reports of a finalized US-China trade truce and imminent deals with other partners. Japan's Nikkei 225 jumped 1.6% to its highest level since early January, boosted by tech stocks. The broader topics climbed 1.2%. Tokyo Electron shares surged 5% and Sony climbed 2.6%, while SoftBank, a major weight in the benchmark, added nearly 3%. Meanwhile, data on Friday showed that Tokyo's consumer price index rose less than expected in June, casting doubt on whether the Bank of Japan has sufficient room to raise interest rates further in the near term, falling to 3.1% year on year. This was down sharply from the 3.6% gained in May and below the market estimate of 3.3%. Japanese yen has edged higher on Friday in the North American session, and it was sitting last at 144.65, up 0.16% on the day. Other Asian markets only edged higher as investors cautiously brace for the July 9th deadline, when US reciprocal tariffs are expected, potentially escalating trade tensions. A formal written trade agreement between the US and China is a positive development that should reduce the risk of further misunderstandings, but the truce still remains on shaky foundations. That's according to analysts at Capital Economics. US Commerce Secretary Lutnick told Bloomberg on Thursday that the US and China had finalized a trade deal first outlined in Geneva, adding that deals with 10 key trading partners were imminent. But while a swathe of recent economic readings shows some pressure from the US tariffs, they also highlighted resilience in the world's second largest economy. China's Shanghai Composite Index was largely unchanged, while the Shanghai Shenzhen CSI 300 edged 0.1% higher. Hong Kong's Hang Seng Index rose 0.4%. Bucking the regional trend, South Korea's Kospi declined 0.8% due to continued profit-taking after stellar gains earlier in the month. And at the close, the Nifty 50 in India gained 0.35% to hit a new 6-month high. India's main stock indices are likely to climb towards record highs in July too, powered by sustained domestic inflows, macroeconomic fundamentals, and strength in blue-chip companies such as Reliance Industries, according to two brokerages. The Reserve Bank of India's policy of supporting an uptick in economic growth, moderating inflation, and robust domestic inflows have driven gains of about 15% each on the Nifty and the Sensex since the start of March. They're now less than 3% away from their all-time highs that were hit on September the 27th, 2024. Australian shares paired early gains as investors took profit on the huge rally in Commonwealth Bank shares and rotated into mining stocks. The ASX 200 rose as much as 0.6% in early trading before swinging lower. The benchmark index actually closed down 0.4% at 8,514, with 8 of 11 sectors tracking lower. Still, the Australian share market edged 0.1% higher over the week and sits well within striking distance of record levels, maybe. Traders locked in a rate cut by the Reserve Bank of Australia in July after to show that inflation fell to the equal lowest rate in almost 4 years last month. Bond markets imply around 4 more rate cuts in the current easing cycle. Headline inflation fell to 2.1% in May from 2.4% in April, which was below market expectations for a 2.3% outcome. The softened expected figures prompted a chorus of economists to bring forward their rate cut forecast to July, with Capital Economics becoming the latest firm to shift its expectations on Friday. There are growing signs that Australia's economic recovery is struggling for momentum. Both CPI data and business surveys suggest that this weakness in activity is translating into softer inflationary pressures, said Capital Economics. There is a compelling case for the RBA to loosen policy more aggressively than we had previously anticipated. AMP head of investment strategist Shane Oliver said July is normally a strong month for shares and a break to record highs could be imminent. However, volatility is likely to remain high. Investors cashed in on the blistering rally in Commonwealth Bank shares, dragging the stock 2.8% lower to 185.36 on Friday, but still comprising about 12% of the total index. Ooch. ANZ, National Australia Bank, and Westpac all fell by nearly 2%. Traders instead snapped up the major miners as iron ore futures in Singapore rebounded 1.2% to $94.75 a tonne. BHP rallied 3.9% to $37.53. Rio Tinto rose by 4.6% to $108.97, and Fortescue advanced 3.6% to $15.46. Lithium stocks enjoyed a second day of gains, buoyed by news on Thursday that Vanguard became a substantial holder of PLS, that's formerly Pilbara Minerals. PLS rose another 4.6% on Friday to $1.38, while IGO climbed 2.7% to $4.12. Oil was on track to post its biggest weekly decline in 2 years after a ceasefire between Israel and Iran. Woodside Energy eased 0.6% to $23.72, but Santos added 0.4% to $7.66. Health stocks were broadly lower, with CSL, ResMed, and Sigma all down around 2%. And in corporate news, Reese tumbled 18.7% to $14.12 after announcing its earnings for the 25 financial year was expected to fall in the range of $548 to $558 million. That's down from $681 million the year prior. The supplier of bathroom and plumbing products also revealed former NAB chief executive Ross McEwen was retiring from its board. Breville gained 2.6% to 29.50 after Jardine Securities upgraded its rating on the kitchen appliance maker to overweight. And Woolworths, which announced that it would close its loss-making My Deal marketplace just 3 years after purchasing it, dipped 1% to $31.14. Supermarket rival Coles dropped by 1.7% to $20.82. The Aussie was at 0.6533 against the weaker US dollar, as analysts warned that it was still vulnerable to a sharp drop around 9th of July, as it did in early April if President Trump reinstates unilateral tariffs, and the Aussie was at a weak 47.60 against the UK pound. The recalibration of the Fed's policy outlook this week coincided with similar moves in Australia's bond market, with the 2-year at 3.249 and the 10-year at 4.182. Finally, in crypto, Bitcoin is on track to finish the second quarter of 2025 with a return of nearly 30%, though reacting to global market uncertainty and geopolitical tensions created a fall from its record high of 111,000 back in May. It was last at 107,360. In the past 2 months, the most popular cryptocurrency has been trading between 100,000 and 110,000 US dollars. Trading volumes have been low in both spot and future markets, and individual investors are being cautious. Bitcoin's spot trading volume is currently just $7.7 billion, according to Glassnode. That is much lower than was seen through 21 to 22 bull markets. This low activity suggests that retail investors have not yet returned to the market in large numbers. On the other hand, long-term holders are still buying, and in fact, a liquid supply, Bitcoin held in wallets with little or no selling history, now accounts for 75% of the total supply. This limited available supply is one of the key reasons prices have not dropped. Meanwhile, US-listed spot Bitcoin ETFs have attracted over $2.9 billion in net inflows over the past 13 trading days. FBS, one of the leading global brokers, released a new market analysis asking the question, has Bitcoin's bull run peaked, or is another major rally still ahead in 2025? According to the article, Bitcoin is now trading between 106 and 110,000 US. Some traders believe this is just a pause before the final surge, while others think the market may have already reached its high point. Market sentiment is getting very optimistic, a sign that some investors may be acting out of fear of missing out. Leverage trading is on the rise again, which can lead to big swings in price. Some analysts believe this may signal the top is near. Global events added some uncertainty. In June, tensions in the Middle East caused Bitcoin to drop suddenly, reminding traders that crypto still reacts to fear and global risks. At the same time, new crypto regulations in the US and Europe could either help Bitcoin grow or slow it down, depending on how they're applied. Bitcoin could still climb higher, especially if the US starts cutting interest rates later this year, FBS analysts said, but it's important for traders to manage risks and stay prepared, which I think is an appropriate message more broadly for investors. There are material issues under the hood which could shift markets considerably. The nothing ever happens trade is, I think, a cop-out for those not willing or able to deal with the flood of contradictory data. But there are signals amid the noise for those who want to see them. Check out my live show with Damien Classing next Tuesday for more on that. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.